I think what distinguishes good operators from bad operators at this point in the cycle is the ability to manage the expense side. So prices are escalating, rents are increasing. You got to try to make sure that your expenses aren't escalating at the same pace. And that's a challenge.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny Cattani, and the founder of Cattani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? And welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Randy Langenderfer. Randy is president of InvestArk Properties, LLC, focusing on creating investor value and passive income returns for the busy professional. He has been in multifamily real estate since 2014 as both the general partner, key principal in 700 doors and a limited partner in over 4,000 doors. For the busy professional who wants to include multifamily in their portfolio, InvestArk provides an opportunity to partner with experts who are aligned with their investment goals. Randy, welcome to the show.
Jonathan, thank you very much. It's a pleasure to be here this morning.
Absolutely. Glad to have you. We finally decided to hit record. We almost did a whole episode offline, which was great. Both aligned with capital raising and everything, which is always fun to talk about. So, you've been doing this for a while. You've got a nice portfolio, but you did mention offline, you still have a W-2. So kind of take us back a little bit, what's your W-2 and what led you to real estate?
Thanks again, Jonathan, for the opportunity to be on your show. I look forward to hopefully providing some value to your listening audience. So Randy Langenderfer, I'm currently based in Houston, Texas. I have been here for 9 years, transplant from the great state of Ohio, as most people are in the Houston area. I'm currently employed as a W-2 employee at a large academic medical institution here in Houston as in the governance areas, corporate governance, cybersecurity, IT, audit, privacy and compliance, and I oversee those areas. And I think it makes me a much better general partner because I've been a limited partner, and I started out my journey in 2014 after going to a couple of different big educational groups, and I settled in recently in Rod Khleif's organization. I'm a coach and part of his mastermind. But when I started out as a W-2, and I dipped my toes in the water with my first LP investment and second and third. And it was probably 3 or 4 years before I did my first GP. And now I'm really trying to grow that side of the business. And to your listening audience, this can be done. I mean, I think the best place is full-time people in the space, but it can be done part-time. You're going to work. Hopefully you're not afraid of that, but it's very doable.
I love it. Yeah, it's, a lot of people started, did the full-time W-2, waited till their income was replaced. That's a very, very common path. Do you anticipate leaving W-2 or are you going to stick with it?
Not for the foreseeable future. I mean, in the case anybody's out there from my employer listening,
I was going to say they're listening.
I have no immediate plans, but if the real estate really kicks into high gear, when I talk to students, I always encourage them to not leave their W-2 until they can replace their existing income. And so that's important. And I'm blessed to have an opportunity before me that I need some more GP opportunities to replace that income, shall we say. And that's kind of where I'm at. I enjoy what I do on a day job. It's not, I enjoy multifamily too. And so I do work like you, probably a lot of nights and weekends as well too, but that's okay. You find something you enjoy. My dad said, you never work a day in your life.
It really is the truth. It doesn't feel like work, just like how we were talking for 25 minutes before. It doesn't,
right.
Super easy to talk about. I could talk about it all day, which is why I have a daily show. I love it. So I get that for sure. What was it when you were an LP that made you want to transition to the GP?
I think it was natural evolution. Most LPs don't understand the work that goes into the GP side, and they think you're just raking in money. And we all know it can be profitable. I'm not downplaying that side of it, but it's also work. There's a lot of work involved in it, of identifying properties, building those networks, building, acquiring capital. And then if you do all that, then you get to operate the property and you got to make it work. And so that's what interested me first. Of, I guess, to take a step back, I was in corporate America. I was working for a private equity company, and those jobs tend to be short-termed. And so I didn't want to, it wasn't at the point where I could do this full time yet, even financially. And so I was looking for an alternative income stream. It's a short answer. I was just really looking for an alternative income stream. And again, I'm very background wise, I'm a finance, CPA, MBA type. So I'm pretty risk adverse to begin with. And so I really wanted to educate myself thoroughly before I did this. And so that's the other point for your audience and the people that I talk to on the coaching side. Educate yourself, you don't have to know everything about everything, but people are afraid to invest in an educational program, but yet many of us spent tens of thousands or hundreds of thousands of dollars on our formal education, college, whatever.
Isn't that fascinating?
But yeah, I get these people that they're reluctant to spend $1,500 or whatever. Everybody's case is different, but educate yourself on the investment opportunities, on the different aspects of it. And so I keep building pieces to that puzzle. And I'm not going to say I'm proficient in all of it, but I'm always a student, always learning, and I just enjoy it. So
I love it. Yeah, there's something new every single day in this industry, which I love, whether it's the changing economics or, you learn something new, whether you're a GP or an LP. And I do feel like it is a progression. You invest passively, you start to see it. And then, I feel like the more you learn, the more you want to be involved. And so naturally you kind of move to that GP stage, which is where you're at now. You're about to increase your GP door count, which is awesome. One thing we're talking about offline, you're in multiple markets, which are very different markets. We talked about a Greenville acquisition, Greenville, South Carolina, and Tucson. What have been the keys to kind of diversifying geographically?
So I own in Houston, Texas, Dallas, Texas.
Wow.
Greenville, South Carolina, about to close on in the next couple of weeks, in Tucson, Arizona. And if there's a theme to any of those, I think it's joint ventures and partnerships. So, I had a friend, and people start to invest in their own backyards or want to buy a multifamily wherever they live. And that's rational because they know the markets. But I had a friend that tell me, I live in Houston. So if I drive 3 hours to San Antonio to see a property, and I'll do it again, or to Dallas, which is 4 hours away, what's the difference between that and a 3-hour plane ride to Greenville, South Carolina, or a 3-hour plane ride to Tucson, Arizona? But that's a mental hurdle people have to get over. So, and for me, the consistency in both those is partners. That I've been asked to join partnerships in those markets with proficient operators who have the local arrangements and relationships that would take me months, years to build. So I'm propelling and jumpstarting my strategy of finding just growth markets in Greenville and Tucson that have, and Dallas is, I got a different set of partners up there that I've partnered with, and that one's just a home run opportunity for us. Houston's a much smaller property. It's a 60 unit that we acquired in February of 22. It's finding challenges in a smaller property and how the previous seller kind of rented it up with some unworthy tenants before he sold, and another lesson that we learned. But partnerships, this, as you know, Jonathan, this is a team sport, and you got to have friends and or partners.
Yeah, absolutely. And it has to be, obviously, so I guess the question, what's your process for vetting your partners, right? You're obviously very keen on that. And it's important that we, make sure that we're going to work well together and have complementary skills as well.
So I can run through the list, and I would say most of the ones, well, yeah, I've known for a long time before I've partnered with them. So it's going through networking opportunities, educational opportunities, having met them at various meetups, seminars, et cetera, and just building a relationship. It's just building a relationship. So the one here that we did in February with my Houston partners, I've known them for 2 or 3 years at least. And we finally just talked about doing a deal together. The Dallas partners were referred to me by the Houston partners, and they had a relationship already. And this was a very big deal. It's 396 doors. There's really an $80 million buy.
Wow.
So they need, yeah. So I brought my capital raising abilities there, as well as operations, and I'm in the asset management calls, et cetera. Tucson was a no-brainer. The guy came to me. I've known him for 3 or 4 years. I've been wanting to get to that market. I've made exploratory trips there. I've tried to build relationships with the property managers and different. And so that was a no-brainer. Greenville came to me, just again, professional affiliation, but I didn't know these guys as well. And so, when I say I'm a GP, I get on the plane and I go to those markets. I look at the opportunity. I drive all the comps. I see it and touch it and feel it. And my Greenville partners, I hadn't known as long. They met my gut told me they were okay. I checked their references. I actually hired an attorney, did background checks on these guys. Full background checks. They volunteered. They knew I was doing it. They wasn't behind the scenes or behind their backs. Legal background checks.
Absolutely.
Just to make sure, because I think the caution to your audience is, my Rod Khleif, my mentor, had the phrase that, partnerships are like a marriage. They're easy to get into, but very difficult and painful to get out of. So don't just partner with anybody. And, you'll have people that come to you, hey, I need balance sheet help. Will you sign as a KP in this loan? Heck no, don't do that unless you know them.
Yeah.
You know the deal. I have done that before. Quite honestly, I've always made sure that I have KP'd on the loan with somebody that has a whole lot more net worth than I do.
Absolutely.
So that in the event something bad would happen, they're going to go after them first. Call me selfish, or smart, whatever you choose to look at it. But the first one I did, I learned I did it for zero compensation. But,
oh wow!
Yeah, dumb me. I did it for zero compensation, but the 2 guys in front of me had triple my balance sheet. Put it that way. It was a fairly safe bet. But
right on. Yeah. So it sounds like in the beginning you did maybe, jump into a few things early. Did they work out at least?
Yeah. The KP that I mentioned there that I did zero compensation, we're selling, actually in the process of selling now. It is 6 years into it. We're going to get about a 3.5x equity multiplier. So I'll take that.
Yeah. It's a pretty nice day at the office.
Our Dallas property, crazy markets. We bought in December of 21, and we're going to list it next month.
Wait, like 8 months ago?
Yeah.
You bought it? Oh
the broker, and it's nothing, I'm not smart. It's just the market and just where we're at in the
right
cycle.
Of course. Right.
I wish I could take, but anyhow, the broker is insistent that we bought this $80 million deal that we can sell 12 months later for north of 110 million.
Jeez Louise.
That's just, you got to have some luck along the way too. So I'll take the luck.
Yeah. The market is a factor, right? Like, you're not just buying anywhere, just to acquire something, you certainly, there's a reason you're in these markets. And this is one of the reasons, is that they, and in a good economy, this is one of the luxuries of those markets, is that incredible, you look at companies like Rise 48 and
in
Phoenix, they've absolutely exploded, right? Because they, and they're an incredible team and they've got an incredible operation, but they've enjoyed a nice market, and, Dallas is doing the same thing. What do you anticipate, or what are you seeing at all, if anything, in these markets, in any kind of slowing economically?
Well, that's a great question. Everybody's got, if I had that answer for you, Jonathan, I'd probably be on Wall Street making a whole lot more money, but I guess everybody has an opinion. I think my opinion is that, yes, we're headed for an inflation. Inflation is up. We know interest rates are rising. They're going to, I don't know how far, where the end point is, but I guess my personal horizon is that it's the Pensford is the monthly newsletter that I subscribe to on interest rates, and then encourage your audience to go out and get it to Pensford. You can subscribe to their monthly news. I think it's weekly newsletter, and he talks a lot about interest rates, and he's a professional. And I would say that the best information I get is that from the time the Fed starts raising to the time the Fed starts lowering, from the time the Fed starts raising to the time the Fed starts lowering, is anywhere since they've been tracking this in the history of time, 26 months from the time the first raised to the time it starts to lower, from 26 to 36 months. So that puts us in an escalating market through probably mid 24, mid 24, late 24 to sometime in 25. So I think interest rates are going to rise. I don't know how fast, but they're rising. All the properties I've got, we're doing bridge debt with rate cap insurance. So we mitigate that factor with that. It's getting a whole lot more expensive than it was even in February. So I think asset prices are, I told one of our investors, we bought this 60 unit in February here in Houston. It's a Class A. It was built in 2018. It's a lovely unit. It's just small. I said, I think that property is going to rise in price if we do absolutely nothing. If we just keep filling it. I mean, asset prices are going to increase with inflation too. So you got asset prices inflating, you got interest rates rising. You're going to see rent growth continued, at least in the major markets I know of. You're going to see rent growth. Tucson is just off the charts. Rent growth. I mean, they are talking about the next 5 years to be the #1 place in America for rent growth in Tucson. And so I think what distinguishes good operators from bad operators at this point in the cycle is the ability to manage the expense side. So prices are escalating, rents are increasing. You got to try to make sure that your expenses aren't escalating at the same pace. And that's a challenge, from personnel to supplies and everything else. I was just on an asset management call before this one, and personnel costs are going up. But I think that's what really is going to differentiate good operators from bad operators. And what kind of debt did you get? Because there's many different types, and I think a lot of operators today aren't getting debt that really meets their business plan. So you really got to make sure your debt matches the business plan, whether you're going to hold it for 5 years, 7 years, 2 years.
Yeah, absolutely. I've been saying this for a little while on the pod, is you're really going to start to see who understands that this is a business, and operates it as an efficient business, and who just enjoyed, incredible market run and more or less got lucky, and that's going to present some opportunities, I think, as well. And not that anyone's malicious, but, if you haven't been in the game very long, it's brand new. This is a brand new environment. My generation especially has never seen this heavy of an inflationary environment.
Yeah, you've never lived through, I don't know how old you are, but most likely you've never really lived through a down market. I've lived through 2003 and 2008 and 9 too. And I go back to the way for your listeners, the way to mitigate some of that risk. Because I thought I'm trying to look at those high growth areas, high population, high income growth, Houston, Dallas, Tucson, Greenville, South Carolina. They click that box, they check that box. Great operators in those markets, they check those boxes. So this is the way I sell it to my investors. I say, first you look at the sponsorship, you look at the market, and then you look at the deal. So it checks the box of the sponsorship team, it checks the box of the market. And then, okay, now I look at the actual asset itself. How's it underwritten, et cetera, et cetera. And so as your audience is trying to find opportunities, go to the networking events, talk to people, find somebody that has got, or that you want to find an opportunity, whether it's a 40 unit or an 80 unit or 2,000 unit, I don't know. And you stand a better probability of success in one of those higher growth markets than, I'll say, Toledo, Ohio, where which is a declining market. It's there's not people moving to Toledo. There's not people. I pick on that because I know that market. I would live there at one time. Just extreme examples.
Right. Absolutely. Yeah, that's incredible. That's great advice. And what about even, drilling in even further, someone who is still unsure, wants to make their first investment, but, maybe looking at this as, oh, I'm just going to kind of sit on the sidelines, any advice for, really learning the power and understanding that this is actually a time of opportunity and not a time to sit and wait.
That's a great one. So I had an investor that I've been talking to recently in these two deals, and well, is this really the right time? Interest rates rising, et cetera, et cetera. And, I don't really try to talk them out of it. I just try to give them the facts and kind of my view. I think, so the old illustration, when's the best time to do this? I mean, the answer is 20 years ago or today. 20 years ago or today. And I think it was Albert Einstein or somebody that said that. It's not new with me, but, and that is true too. So you got to get started. And so I've said, I come from that finance background, a very analytical mindset. I started out in underwriting, and that's where, because I love a good spreadsheet. And oh my gosh, to your newbies, I mean, when you start looking at the variables in a spreadsheet, in an underwriting spreadsheet, you realize there's a lot of different variables that can change. There's just a lot of variables in there, and you try to do the most conservative thing you do, and try to make it rational thinking. But business happens, and not always a good thing. But so I think the investors should really start out understanding the model and passively invest. Ask the sponsor if you can come alongside them. Hey, I'm interested in doing this. Can I call you? Can I walk the units with you? Can I do the lease audit? Can I participate in some of the due diligence? I've done it before. I think any rational sponsor is going to let you do that. If you really want to get involved in it. And the first couple LPs I did, I was prefaced it with a sponsor to do that, and I got on monthly calls after I got the financials and started asking questions. As long as you're not being a negative or a pessimist and asking all the, why'd you do this, why'd you do that? But if you have a general heart of trying to learn, people are going to work with you. They're gonna embrace you because they're always looking. They know it's a team sport, and they're always looking for future partners too.
Absolutely, that was very, very well articulated. I could not agree more. And if you're not getting that information, or they're not helping you, then that's a big red flag, right? So that's a easy way to start the vetting process is, asking questions and, asking to meet with the team, whether you want to walk the asset. I mean, that kind of varies for sure. It depends where it is and different things like that, but you should be able to, at some point, go out and actually see it. And you obviously work hand in hand. You are a busy professional and work hand in hand with them. For those that are super busy, maybe don't have the time to deep dive into underwriting, do you have like a short list of things that you're like, hey, this is what I I mean, because for me, right, and you're obviously on the capital raising side as well, it's like, hey, I've done all of this, right? I'm the one who's done all of this. So, you know, you can kind of trust me that I've done my process, but, you know, they probably still want to have their own little checklist as well.
Yeah. And so as I coach people today, I always talk about the shiny object syndrome. So we as investors get attracted to what I call the shiny object syndrome, which is, oh, this opportunity has a 22% IRR, or a cash on cash of 20% a year. So throw out some exorbitant numbers, but I mean, well, this self-storage has this, and this multifamily, and oh my gosh, there's crypto out there that's got phenomenal returns. Why am I in
Don't forget RV parks.
RV parks. There you go. So what I really encourage investors to do, starting, as I said, write down your investment strategy. You know, so I've said, write down on a piece of paper your investment strategy. That doesn't mean you can't change it, but to start with, what is your investment strategy? So what kind of markets are you looking at? Well, narrow to an asset class: multifamily, self-storage, mobile home parks. They're all great investments. I mean, I don't know anything about crypto, but I know people made a lot of money at it. People lost a lot of money too.
Yeah.
But write down your investment strategy. What kind of asset class you're looking for? What kind of opportunity? You got to look at a 4-unit, or are you only looking at something over 100 units? And start to talk about those. I mean, very simply, what category, what asset class you're looking at? How big of an asset? I mean, are you only looking at Class A opportunities, Class B opportunities, C's? So, I mean, I'm sure you do too, Jonathan, a lot of opportunities to invest come in my inbox every week, and I just go back to, and somebody sends me an opportunity in Topeka, Kansas for 20% IRR in 3 years or whatever. Well, do I know the sponsors? That's the other big item there, is start to make relationships with sponsors. And that should be a key element in your investment decision. I don't know anything about Topeka, Kansas. And even if I knew the investment group, maybe the investment sponsors, maybe I'd look at it, but it's not in my wheelhouse, even though it's got a great IRR pass. I'm looking at the Southeast, the Southwest, and Texas. So I would really encourage people to start to develop that a written investment strategy, and write it down, because then you've locked in and you can use that as your checklist. You may change after you do your first investment or 6 months into it, but I settled in on multifamily. I educated myself. That was a big investment strategy. I'm still educating myself. I'm looking at certain markets. I'm looking at certain age of assets. I'm not interested in a 50 unit. I'll probably never do a 60 unit again. I'm looking at 90 units and above. I'm looking for looking for a sponsorship team that has a proven track record in those markets. So, you know, somebody could say to me, Randy, what do you know about Greenville? Well, I have looked at a lot, but I've got a partner now, and they've gone through 4 full cycle assets in that market, in the South Carolina market. Check.
Yep.
So it's not just where your experience is, but I know another GP deal that focuses on Austin, Texas. They've never gone full cycle yet. They've been in the game 4 or 5 years, and they're holding assets, and that's fine. But just be aware of that as an investor. So,
yeah, I love it. That's such incredible advice, and you know, that's the right way to do it. And so, if you're brand new, these are great first steps. You know, why are you investing? Why do you want to invest in real estate? What do you want to accomplish? And of course, remember, it's all long term, right? None of this stuff is overnight stuff. And you can even delineate it further. Do you want to invest for cash flow? Do you want to invest for upside? You know, what is it you want to participate in? You know, are you looking to have, you know, heavy, you know, even tax wise, you know, kind of, you can break it all the way down that far as well. So I don't want to overwhelm anyone. I feel like we just added more, but you know, again, a lot of this stuff can be answered by just making a phone call and just talking to, these teams that you're going to partner with or invest with, have an investor relations, someone who knows exactly, how to answer all these questions and will give you all these answers. So don't be afraid to just make a phone call, and you'll get a lot of this stuff alleviated and answered pretty easily.
And there's no dumb question.
Nope.
I've got a couple of investors, very timid and asking me, look, it's your money. You have the right to ask any question you want. You have the right to ask any question you want, and you should. And as a sponsor, I really enjoy when people, so I've seen both sides. I really enjoy when people ask me questions. That shows they're engaged and they want to learn, versus I have a couple high net worth investors that, if Randy says it's okay, I'll invest. But the ones I enjoy are the conversations.
Absolutely. Yeah. It feels better that way too when they do invest, because then you're like, okay, this person, made a sophisticated decision as opposed to, just wrote a check. But
I have to me, it's a burden, an immense burden on myself as a raiser. I mean, I'll give you the example today. I just had an investor invest $55,000 in one of these properties, and she is coming back from the mission field and just inherited an IRA, my father's IRA, and she's wanting to invest this inherited IRA. And this is like a woman coming from a mission field with pretty meager means in this investment opportunity. Well, one, I'm humbled at the fact that you want to do that, but two, I take that responsibility extremely serious, and I kept asking, are you sure you want to do this? As you said, Jonathan, this is a long-term illiquid investment. This is a 5 to 7 year run, most likely. And, if you need money, you're not going to be able to take it out of the cash, out of the stock market, like the stock market. So it's, if you take it serious, if you take your job as a sponsor, I think the way it needs to be, I mean, you're really saying, be double sure on this opportunity. If you don't want it, I'm fine with that. So take it seriously too.
Absolutely. I love that. Awesome. This has been incredible. I appreciate all of this insight. I know the listeners do as well. So we'll jump to the final 5 now here as we wind down. First question, best advice you've gotten from a mentor?
Education and persistence. Take the long view. I was listening the other day to a podcast, because I do that all the time when I get in the car, and they were talking about people, these hedge funds coming into markets and overpaying for single family houses. And they were talking about, but they take a 20-year view of it, and asset prices always rise over a 20-year period. So take the long view, continue to educate yourself, be persistent.
Absolutely.
Take the long view.
Great advice. What is it about your career that makes you feel like you're fulfilling your why?
What is it about my career that's making me fulfill my why? One, I try to be persistent and stay in the game and educate myself, but I think I'm getting returns. And, my why is I want to give back to several charities. When my tax guy tells me, Randy, it's defer, 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 and die. So not a pleasant thought, always the last
Well,
part.
listen, he's a CPA, so you can't have,
don't have any humor.
Expectations.
But the point of it is
but we love them.
So my why, we need them. And my why is there's several charities that I really want to give back to, as well as my kids a little bit. And so I'm working towards that. I'm making progress is the answer to your question.
I love it. That's awesome. Love that perspective. Favorite non-real estate or investment related book?
Two books. My bias is I'm a person of faith, so I always got to throw the Bible in there. That would be the greatest book I ever read. But then on the business side, I would say I still love an old version now is Stephen Covey's 7 Habits of Highly Effective People. Yeah, it's a great read that everybody. It's kind of like Kiyosaki's book on Rich Dad Poor Dad. Everybody should read 7 Habits of Highly Effective People.
Agreed. Yeah, it's a great one. If you could have any superpower, what would it be?
Yeah, I've been asked that question before, the superpower, and I don't consider myself necessarily, maybe it's because I just watch too many movies, but I would say my superpower is, again, persistence and staying in the game. Don't compare yourself to everybody you see on Facebook that's got this deal and this kind of return, blah, blah, blah. Compare yourself to yourself and what progress you're making. So stay in the game and be persistent.
Love it. Last one. What's the best way for people to get a hold of you and learn more?
Well, Jonathan, really invite any of your audience, even if you need just a little update on a current project or whatever. I'd love to talk to you about anything real estate. As we said on the show, I'm both nerds and enjoy talking about this stuff. So the easiest way to get a hold of me is on my website. It's InvestArk, invest-ark.com. And there's a contact us page on there, and contact me, I should say, and love to schedule an appointment with you. You can schedule an appointment with me and would love to talk about anything real estate.
Beautiful. We will link that in the show notes, make it super easy. Randy, thank you so much for your time. This has been amazing.
My pleasure, Jonathan. Thanks to your audience. Wish everybody good luck in their investment journey.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.